SoFi stock is a sell before earnings. SoFi Technologies earnings report predictions and strategies. Hey investors and finance enthusiasts! Welcome back to our channel for some exciting insights on SoFi Technologies, a leading fintech company. In this video, we'll explore SoFi's upcoming earnings report and analyze 4 thought-provoking articles about its stock performance. First up, SoFi is a sell before earnings, raises concerns about potential risks impacting the stock. But it's not all bad news. Want to buy why SoFi stock is a compelling pick on the booming fintech space presents a bullish outlook, revealing enticing investment factors. Next, is SoFi stock overvalued or underrated? Here's my take. Provides a balanced perspective in SoFi's valuation debate. Lastly, SoFi Technologies Incorporated, or SoFi, is attracting investor attention, offers essential insights into recent developments capturing investors' interest. We'll craft a strategic approach to navigate uncertainty surrounding SoFi's earnings. Remember, knowledge empowers us to make informed decisions in the ever-changing stock market. Let's dive in and uncover the potential opportunities and pitfalls that lie ahead for SoFi Technologies. If you find this valuable, hit the like button, subscribe, and share your thoughts. Let's jump right into it. SoFi is a sell before earnings. Alright folks, let's dive into why some investors believe it's time to hit the brakes on SoFi Technologies before its earnings report. The author of the article SoFi is a sell before earnings has had a change of heart after being quite bullish on the company before. So what's got them rethinking their stance? First off, they're worried about changing credit conditions. As the economy faces some potential challenges in the upcoming quarters, delinquency rates on personal loans could soar. They point to recent reports from Capital One Financial and JP Morgan Chase showing increasing credit card delinquency rates. And you know what? These guys think that could spell trouble for SoFi's personal loan business. Now, here's where things get a bit complex. The economy is projected to slow down and unemployment rates are expected to rise. That means more people might struggle to pay back their loans, affecting SoFi's bottom line. Plus, tighter economic conditions could lead to both consumers being hesitant to take on new loans and SoFi being more cautious about lending out money. But wait, there's more. The Federal Reserve is also planning to hike interest rates a couple more times in 2023. Higher rates could squeeze consumers even further, making it harder for them to handle debt. And guess what? That could lead to lower demand for loans altogether. Lastly, there's the matter of SoFi's valuation. The stock's been on a tear, and now some think it's gotten a bit too pricey, especially considering the potential economic challenges ahead. Even though analysts predict massive earnings growth in the future, the current valuation might be a tad over the top. Of course, no bearish thesis is complete without considering the risks. SoFi's main growth driver is personal loans, and those tend to have better interest rates than credit card loans. So if there's a high interest rate environment, consumers may flock to personal loans for debt consolidation. Plus, SoFi boasts a strong customer base with high-quality borrowers, providing some insulation during economic slowdowns. So there you have it. The author believes SoFi is facing headwinds due to potential delinquencies, slowing economy, rising interest rates, and an expensive valuation. Is it a sell before earnings? Well, that's the question they're posing. Remember, this is just one perspective, and the market can be a wild ride. Want to buy why SoFi stock is a compelling pick on the booming fintech space. Now, despite its recent gains, SoFi stock is still below its all-time high. One of the big reasons investors are excited about SoFi is its impressive growth. Revenue has shot up by 43% in the latest quarter, thanks to a solid customer base of 5.7 million. They offer a range of financial products that attract customers with competitive savings rate and extended FDIC coverage, making it a safe haven for their money. As the federal student loan repayments are set to resume, SoFi could benefit from increased refinancing activity, which is a positive sign for their business. However, not everyone is all in on SoFi. Some analysts, like Morgan Stanley, have downgraded the stock, saying it looks more like a bank now and should be valued accordingly. They're also a bit skeptical about the size of the refinance opportunity and have some concerns about SoFi student loans compared to personal loans. But here's the thing, SoFi has been diversifying and expanding its services beyond just student loans. They've seen strong revenue growth, and even though the student loan repayment moratorium was a challenge, their other segments helped offset the impact. They've been working hard to improve their financials, and it's paying off. They've narrowed their net loss and are making positive strides towards profitability. Overall, SoFi is looking pretty promising. Their valuation seems reasonable for a high-growth stock, and as new customers come in and student loan repayments pick up, their financials are expected to get a boost. Is SoFi stock overvalued or underrated? Here's my take. Now let's go to the ongoing debate about whether its stock is overvalued or underrated. Some folks have been worried about the company's valuation, saying it looks more like a traditional bank than a tech-driven fintech company. Recently, a sell-side analyst downgraded SoFi stock, citing concerns about its valuation. The analyst believes that the current valuation implies a much faster and more substantial jump in profitability that is likely for this digital-first financial services company. But wait, there's more to the story. SoFi is indeed growing, and its CEO Anthony Noto has big plans for the company. He envisions SoFi becoming one of America's top 10 financial firms one day. Now, that might sound ambitious, especially when you compare SoFi's current deposit base to those of the big banks, but don't underestimate their potential to grab significant market share from the traditional banking giants. Sure, there are some uncertainties and investors may have concerns about slower growth in areas like student loan refinancing. However, SoFi's focus on high earners and its rapid deposit base growth shouldn't be overlooked. As we approach SoFi's upcoming quarterly results release, keep an eye on its performance. If they can maintain double-digit revenue growth and swing into profitability as expected, we might see the stock climb higher. Currently trading around $10 per share, there might be an opportunity for gains if SoFi's long-term strategy pays off and it inches closer to becoming a top player in the banking industry. SoFi Technologies Incorporated, ticker symbol SOFI, is attracting investor attention. Here's what you should know. Lastly, let's delve deeper into some important factors that could impact SoFi Technologies' performance in the near future. Over the past month, SoFi stock has been on a winning streak, delivering impressive returns of plus 14.1%, surpassing the broader market gains. It's worth noting that SoFi belongs to the Zacks technology services industry, which has also been performing well, with a gain of 2.5% during the same period. In the world of investing, earnings projections hold significant weight. A company's fair value is often tied to its future earnings potential. Therefore, keeping an eye on how analysts are revising their earnings estimates for SoFi is crucial. At the moment, SoFi is projected to report a loss of $0.06 per share for the current quarter, marking a 50% change from the previous year. Looking at the consensus estimate for the current fiscal year, it suggests a loss of $0.17 per share, but that still represents a substantial 57.5% improvement from the prior year. Looking ahead to the next fiscal year, analysts are optimistic, expecting earnings of $0.01 per share, which would be a significant 107.8% change from a year ago. Considering various factors related to earnings estimates, SoFi Technologies Incorporated is currently rated Zacks rank number 3 or hold, indicating it could hold some potential for growth. Now, let's talk about revenue growth, a critical aspect of a company's earnings potential. For SoFi, analysts foresee robust revenue growth, with estimates indicating a year-over-year change of plus 30.9% for the current quarter and plus 25.8% and plus 22% for the current and next fiscal years, respectively. In the last reported quarter, SoFi showcased impressive revenue growth of plus 39.3% and exceeded consensus EPS estimates 3 out of the last 4 quarters. As for valuation, it's essential to assess whether the current stock price accurately reflects the underlying business value and its growth prospects. According to the Zacks Value Style Score, SoFi's valuation is graded F, suggesting it might be trading at a premium compared to its industry peers. So that's a snapshot of what's happening with SoFi Technologies Incorporated, keeping an eye on earnings estimates and revenue growth as they could impact the stock's performance in the near future. As always, do your research and consider your investment goals before making any decisions. Thank you for watching, and we'll see you in the next one.